Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive into Che. Today, we're taking a deep dive, the common financial mistakes new entrepreneurs make, and maybe more importantly, how you can actually avoid them.
Yeah, it's a huge topic.
We want to pull out the key insights, figure out the biggest pitfalls and find those practical strategies, the habits, the mindsets you need to build to navigate those tricky early stages successfully.
Makes sense.
So we're tackling questions like, what are those common money traps? How do you stop yourself from overspending right at the start?
Big one.
What are the absolute worst budgeting mistakes startups tend to make? And how critical is it really to keep personal and business money separate?
Oh, essential. We'll get into that.
And why does cash flow trip up so many people? It seems like such a fundamental thing.
It is, but it's surprisingly easy to mismanage.
Right. And finally, what are the concrete financial habits you need to develop to actually, stay afloat and succeed long term?
Those are definitely the core questions. And it's kind of sobering how often really smart people with great ideas, they run out of cash.
Exactly. It's not the idea that fails sometimes.
No. Like Startups Magazine points out, starting any business costs money. It's unavoidable. And if you don't have a solid plan for that money, it can just vanish way faster than you expect.
It really is the silent killer, isn't it? You could have the best product in the world, but if that financial engine just ceases up,
you're done.
Yeah.
Score data consistently shows financial problems right up there as a top reason small businesses unfortunately fail.
And looking across the different sources, we have articles, Reddit threads, even deeper stuff like Mike Mikhailovich's Profit First book. You see the same mistakes cropping up again and again.
Definitely. It's things like overspending, trying to scale too quickly, completely ignoring cash flow until it's too late, messing up taxes, mixing personal and business accounts,
right,
which is a huge no-no,
right,
and chasing those vanity metrics, things that make the business look big but don't actually contribute to profit.
That profit first point is kind of scary, isn't it? The idea that a business can look super successful on the outside.
Yeah, the big office, lots of staff,
high revenue numbers, the whole show, but behind the scenes they're just drowning in debt, barely keeping their heads above water.
It happens. It's a really stark warning not to confuse looking successful with actually being financially healthy. Revenue isn't profit.
Such a key distinction. It's not just about money coming in, it's what you actually do with it and what's left over.
Exactly.
Okay, let's dig into some specifics then. Mistake number one seems to be just fundamentally mismanaging spending and budgeting, or maybe not budgeting at all.
Yeah, that's foundational. Both Startups Magazine and Brex really emphasize you absolutely need a budget.
So, what is a startup budget? Fundamentally, is it complicated?
Not necessarily. At its heart, like Startups Magazine describes it, it's just a way to organize your money. Tracking what's coming in, what's going out. Simple as that, really.
Sounds basic. So why is it so vital, especially when things are just starting and everything feels chaotic?
Because it shifts you from guessing to actually knowing what's happening financially. It gives you the data to make informed choices.
Ah, okay.
Can we actually afford to hire that person? Should we invest in that new software tool? A budget gives you that visibility, that runway. Without it, you're just flying blind, reacting to crises instead of planning ahead.
Flying blind. And that often leads straight into the next big mistake, right? Overspending, especially early on.
That came up on the Reddit discussion too. People spending on things like, fancy office decor or getting a bigger space than they need way too soon.
Yeah, I can see that temptation.
Profit First really highlights this danger too. Spending money on stuff that looks impressive but doesn't actually bring in revenue or improve the core product or service. Trying to look like a big successful company before you're actually a profitable one.
This ties right into understanding your burn rate, doesn't it? Forbes and that Financial Intel YouTube video talk about this.
Yeah, burn rate is simply how much cash your business is spending each month to operate. How fast you're burning through your reserves.
So it's like the fuel gauge on your car.
Exactly. And if your burn rate is high, but you're not actually getting anywhere fast, like revenue isn't growing, you're not hitting milestones, then you're just burning fuel for nothing.
Which investors hate, I assume.
Oh, definitely. Is a huge red flag.
Right.
And just for your own survival, really. Forbes suggests aiming for 12 to 18 months of cash runway.
12 to 18 months, wow.
Yeah, it means if zero new money came in, your current cash could keep the business running for that long at your current spending level. It forces discipline.
And this burn rate issue often gets worse with another mistake, scaling prematurely. That Reddit thread mentioned it, And profit first goes into it too.
Oh yeah, this is a classic trap. You have a really good sales month, maybe a great quarter.
You feel like you've arrived.
Exactly. And you immediately increase spending to match. You hire more people, maybe get that bigger office, ramp up marketing. Acting like that peak performance is the new baseline.
But it might just be a blip.
Often it is. And the psychological trap here is what they call loss aversion. Once you've hired those people, sign that lease, it's incredibly painful to scale back down when sales inevitably fluctuate or slow down. You fight like crazy to maintain that higher expense level.
So you end up digging a hole. What's the solution then? Profit first seems pretty direct about it.
It is. Cut unnecessary expenses. Ruthlessly. It sounds harsh, and it's psychologically tough for sure.
Yeah.
But Mike Michaelovitz argues it's often logistically easier than trying to magically generate huge new sales just to cover bloated spending.
Makes sense when you put it like that.
Look at the examples he gives. Those little frivolous costs that add up, maybe office space you don't really need yet, expensive cars that are more about image, extra staff hired just in case.
Right.
The key mindset shift is making spending decisions based on what your business can genuinely afford today from its current real income, not based on wishful thinking about the future or that one amazing month you had.
That's a tough pill to swallow, but crucial. Which leads us nicely to the next big area. Neglecting financial intelligence. Just looking at the bank balance and thinking you're okay.
Yeah. Profit First calls that bank balance accounting, and it's basically a disaster waiting to happen.
Why is it so bad if there's money in the bank?
Because your bank balance today tells you almost nothing about the real health of your business. It doesn't show if you're actually profitable over time, if you have enough cash set aside for upcoming taxes or big bills, or where the money is really going.
Okay, so you need more than just that number.
Absolutely. You need to understand the main financial statements. The big three, as Financial Intel and HubSpot call them.
Which are?
The income statement, the balance sheet, and the cash flow statement. Think of them like your business's vital signs monitor.
Okay, break those down briefly. Income statement.
That shows your revenues and expenses over a specific period, like a month or a quarter. Tells you if you actually made a profit in that time, also called the P&L, profit and loss.
Got it. Balance sheet.
That's a snapshot at one specific point in time. It lists what your company owns your assets and what it owes your liabilities. The difference is your equity, or the owner's stake. Assets always equal liabilities plus equity.
Okay. And cash flow statement. Sounds important given our topic.
Critically important. This tracks the actual cash moving in and out of your business. When cash comes in from customers, when it goes out to pay suppliers, salaries, rent, regardless of when the sale was booked or the bill was dated, it shows the real flow of money.
That Financial Intel video also mentioned a couple of other concepts. Matching principle, revenue recognition.
Yeah, those are accounting principles, mainly for the income statement, that give a truer picture. Matching means you record expenses in the same period as the revenue they help generate.
Example.
If you sell something in June, the cost of making or delivering that thing should also be recorded in June, even if you paid for some parts back in May. It matches cost to revenue.
Okay. And revenue recognition.
That's about when you're allowed to count money as revenue. If a client pays you up front in January for a whole year of service, you generally can't just book all that revenue in January. You usually have to recognize 112th of it each month as you actually provide the service.
Okay. So it smooths things out and reflects reality better.
Exactly. It prevents you from looking artificially profitable just because you got a big upfront payment.
Now, Profit First talks about real revenue. What's that about? How's it different from just revenue?
This is a game-changer concept for many businesses. Michaelovitz defines real revenue as your total top-line revenue minus the direct costs of materials and subcontractors needed to deliver your product or service.
So the money that's actually yours to run the business with.
Precisely. After you pay for the stuff you sold, this is the money left over to cover salaries, rent, marketing, software, all your operating expenses and profit, and owner's pay and taxes.
And lots of people don't realize that difference.
Especially in service businesses or manufacturing, they see the big top line number, think they have all that money to spend, but a huge chunk is already earmarked for materials or subs. They're trying to run the business on money they don't actually control. It's why they always feel squeezed.
Wow. Okay. So the overall solution here is get financially literate.
Basically, yes. Develop your financial intelligence, as the Financial Intel video puts it. It's a skill you learn.
Understand those statements. Use them for planning, like HubSpot suggests. Don't just glance at the bank account.
Right. Look at that real revenue number. Understand your margins. Financial literacy isn't just for your accountant. It's essential insurance, as the Millionaire Fastlane says. It gives you control.
Okay, speaking of control, or lack of it, let's talk cash flow. This seems to be the big one, the reason so many businesses fail.
It really is. Reddit threads, YouTube videos, profit first, they all hammer this point. Operating check to check, as Profit First calls it.
Why is it so hard to manage? It seems simple, money in, money out.
It seems simple, but the timing is everything. Profit First explains the cycle really well. When sales are slow, okay, obviously cash is tight, that's easy to understand.
Yeah.
But the paradox is, it's often just as dangerous when sales speed up dramatically.
How so? More sales sounds good.
It is good. But you often have to spend money first to fulfill those sales.
Yeah.
You buy more inventory, maybe hire temps, ramp up production.
Ah, okay. Your expenses jump immediately.
Right, but you might not get paid by your customers for 30, 60, even 90 days. So there's this gap where your expenses have shot up, but the cash hasn't come in yet.
The classic growing broke scenario.
Exactly. You can be highly profitable on paper, according to your income statement, but have absolutely no cash in the bank to pay next week's payroll. It happens all the time.
Terrifying. So what are the practical fixes? Brex mentioned some strategies.
Yeah, some tactical things. First, obviously, have that budget and monitor your cash flow statement constantly. That's the baseline.
We keep coming back to that budget.
Because it matters. But beyond that, actively manage your receivables. That means getting your customers to pay you faster. Offer discounts for early payment. Follow up on invoices diligently.
Okay, get cash in faster. What about cash out?
Try to negotiate better payment terms with your suppliers. See if you can get longer to pay them, maybe 45 or 60 days instead of 30, without incurring penalties. It helps smooth out your outflow.
So manage the timing on both ends.
Precisely. Profit First also adds some basic but powerful habits. Keep your bills organized, pay them on time to avoid late fees or getting services cut off, and regularly review recurring cost subscriptions, software licenses, and cancel anything you're not actually using. It adds up.
They even suggested using physical checks sometimes. Seems old school.
It does, but the logic is about immediate clarity. When you write a check, you know that money is gone, or will be very soon. It forces you to confront your actual cash balance, rather than relying on a bank balance that might include pending transactions or deposits that haven't cleared.
Interesting psychological trick. Avoid the bank balance delusion.
Exactly.
Okay, next big mistake. This feels like Finance 101, but apparently it catches a lot of people mixing personal and business money.
Oh, absolutely. Huge issue. TD Bank and Reddit both call this out strongly.
Why is it so bad? Seems convenient sometimes just to use one card.
Convenience now, massive headache later. TD Bank points out two huge risks. First, accounting and taxes become an absolute nightmare.
Right, trying to untangle everything.
Yeah, trying to figure out months later which expense was business, which was personal. It's messy, time-consuming, and you're way more likely to make mistakes or miss legitimate business deductions.
Okay, that makes sense. What's the other big risk?
It's about legal protection. If you've set up your business as an LLC or a corporation, one of the main benefits is separating your business liabilities from your personal assets.
The corporate veil.
Exactly. But if you consistently mix funds, pay personal bills from the business account, or use business funds for groceries, you can pierce the corporate veil. TD Bank warns that this could mean if your business gets sued or goes bankrupt, creditors could potentially come after your personal assets, your house, your savings, your retirement fund.
Wow. Okay, so not just an accounting headache, but potentially ruinous.
It can be, yeah. The separation is crucial for that liability protection.
So the solution here is just dead simple.
Dead simple, but requires discipline. Always, always, always keep personal and business finances in completely separate bank accounts and credit cards. TD Bank, Profit First, everyone agrees. This is step one, non-negotiable.
And Profit First takes it even further, right? With multiple accounts.
Yeah, their system advocates for not just one business account, but several dedicated ones. The 5 foundational accounts they recommend are income, where all revenue lands first, profit, owner's pay, tax, and OPEX operating expenses.
OPEX being for the day-to-day running costs.
Right. Rent, salaries, software, marketing, utilities, all that stuff comes out of OPEX. The system involves allocating percentages of your real revenue from the income account into those other accounts. Profit, owner's pay, tax first.
Before you pay the bills.
Before you even look at paying the bills from OPEX. And the really clever part, the behavioral trick.
Putting the profit and tax accounts somewhere else.
Exactly. Ideally at a completely different bank, somewhere that's harder to access easily. It removes the temptation to borrow from your profit or tax money to cover a shortfall in operating expenses. Out of sight, out of mind, dedicated to its purpose.
That's smart. It forces you to live within the means allocated for operations.
It builds the constraint right into the system.
Okay, this really connects to the last big category of mistakes, the ones related to mindset and overall business strategy. Profit First talks a lot about chasing growth just for growth's sake, right? Instead of focusing on profit.
Yes, Mike Michaelevich is very open about his own past experience with this. Building a huge company that looked incredibly successful from the outside, but was hemorrhaging cash and never truly profitable. He was chasing size over health.
So the Profit First formula itself is a mindset shift.
Totally. The conventional formula is sales minus expenses equals profit. Profit is the leftover, the afterthought.
If there is any leftover.
Right. The Profit First formula flips it. Revenue minus profit equals expenses. You decide on your profit percentage first, take it out, set aside taxes, pay yourself, and then you're forced to figure out how to run the business effectively on what remains in the OPEX account. Profit becomes intentional, not accidental.
That's powerful. What other mindset traps did the sources highlight? Profit First mentioned basing decisions on your best month ever.
Yeah, that's another classic. You have one killer month, revenue spikes, and you think, this is it, we've cracked it, time to scale.
Hire everyone, get the bigger space.
Exactly. You adjust your spending upwards immediately, assuming that peak is the new normal. But Profit First warns this is a fast track to debt when things inevitably settle back down or fluctuate. You're suddenly stuck with higher costs you can't sustain.
So the fix is?
Look at trends and averages. Use rolling averages over several months or quarters to understand your typical performance. Base your spending and growth decisions on that sustainable reality, not on the one-off high points.
And stick to those percentage allocations from the Profit First system.
Right. That system automatically forces you to operate based on your actual recent revenue, not just your hopes or your best memory.
Profit First also warned against just chasing any revenue, right? Even bad clients.
Yes. This seems counterintuitive. When you're starting out, you got every dollar you can get. But taking on projects that aren't really profitable, or clients who are incredibly demanding and drain your team's time and energy, that can actually hurt your business more than it helps.
Even if they pay.
Even if they pay. Because the opportunity cost is huge. The time and resources spent on that bad fit could have been spent finding and serving great clients who value what you do and are profitable to work with.
The Millionaire Fast Lane kind of echoes this, doesn't it? Focusing on value creation.
Absolutely. MJ DeMarco emphasizes that sustainable wealth comes from solving real problems and creating genuine value for customers. Money is a byproduct of that value exchange.
And both books actually suggest firing bad clients.
They do.
Wow.
It sounds scary, but sometimes pruning those clients who are unprofitable, disrespectful, or just a massive time sink is one of the most profitable moves you can make. It frees up energy and resources for growth in the right areas.
Okay, what about market focus? The Millionaire Fast Lane had points on that.
Yeah, making the mistake of entering a market without really understanding customer needs or without having anything that makes you stand out.
Just being in another Me Too business.
Exactly. If you're selling basically the same thing as everyone else with no clear differentiator, the only way to compete is usually on price. And that's almost always a losing game, a race to the bottom.
So you need a USP, a unique selling proposition.
Definitely. What makes you different? Why should someone choose you over all the alternatives? DeMarco argues that your USP is foundational to building your brand. And your brand is what conveys value and allows you to command better prices, escaping that commodity trap.
And speaking of brand and value, customer service came up too.
Oh, huge point in the Millionaire Fast Lane. He's adamant. You can have the best product features in the world, but if the customer's interaction with your company, with your people, is poor, you've lost them.
Bad service kills everything else.
It really can. Conversely, he argues that building an amazing, even fanatical customer experience can be a massive competitive advantage. It can overcome minor product flaws and turn customers into loyal advocates who drive referrals. Your employees are absolutely critical here.
We touched on financial literacy earlier, but the Millionaire Fast Lane frames it as a major strategic mistake not to educate yourself.
Yes, he calls basic financial and economic illiteracy a major handicap that dilutes your control. If you don't understand the language of money and business, you're essentially flying blind and dependent on others who might not have your best interests at heart.
So seek knowledge. It's like insurance.
It really is. Insurance against bad decisions, bad advice, and missed opportunities.
And one last strategic mistake from Fastlane: picking the wrong kind of business model.
Yeah, specifically warning against businesses with no real barriers to entry, things anyone can copy overnight, or models where you lack control, like maybe certain MLM structures, or relying entirely on someone else's platform.
So what should you look for instead?
Models where you have control over your product, pricing, brand, distribution. And models that offer potential for significant scale, meaning you can impact millions of people, or significant magnitude, meaning you can impact fewer people but in a very high value way. Control and leverage are key.
Okay, wow. We've covered a lot of ground, a lot of potential mistakes. Let's try to synthesize this. If you're a new entrepreneur listening to this, what are the absolute must-do financial habits that emerge from all these sources? The positive actions.
All right, let's boil it down. It really comes down to intentionality and discipline, like we said.
Okay, habit 1 feels like the starting point. Absolutely separate personal and business finances. Use dedicated accounts, no excuses.
Couldn't agree more. TD Bank, profit first, crystal clear on that. Habit 2, create, use, and actively monitor a budget and your cash flow. Know the numbers.
Brex, Startups Magazine, Financial Intel, they all hit that hard. Habit 3, know your burn rate. Manage expenses based on reality, not hope. Cut ruthlessly if needed.
Yep. Forbes, Financial Intel on burn rate, profit first on cutting costs. Habit 4, make profit intentional. Prioritize it first using a system. Don't leave it as an afterthought. That's the core of profit first.
Habit 5, get smart about your financials. Understand your statements, especially cash flow and that real revenue number. Look beyond the bank balance.
Financial Intel, HubSpot, profit first, all push this. Habit 6, manage the timing of money. Collect receivables faster. Negotiate payables smartly. Pay bills on time.
Good practical tips from Brex and Profit First there. Habit 7, keep learning. Continuously build your financial literacy. It's an ongoing process.
Essential advice from Financial Intel and the Millionaire Fastlane. Habit 8, focus on creating real value, solving real problems, and don't be afraid to fire those bad clients who drain you.
Value focus from Millionaire Fastlane, firing bad clients from both Fastlane and Profit First. Habit 9, build a strong brand identity and deliver outstanding customer service.
That's a huge lever for long-term success, emphasized heavily in the Millionaire Fastlane. Habit 10, be smart about funding. Avoid parasitic debt that just eats your future.
Yeah, Millionaire Fastlane was very strong on avoiding bad debt. Habit 11, choose partners and advisors very carefully. Trust, but verify.
Crucial point from the Millionaire Fastlane. And finally, habit 12.
Focus on execution. Ideas are great, but making it happen is everything.
That's the essence of the Millionaire Fastlane's message. Stop planning forever and start doing intelligently.
That's a really solid list of habits. And, listening to them all laid out, it strikes me how many are interconnected. They're not just isolated tasks.
Definitely. They build on each other. Good budgeting supports cash flow management. Understanding statements informs spending decisions. Focusing on value helps avoid bad clients. It's a system.
And it feels like it's less about complex math and more about behavior, discipline, facing reality.
I think that's exactly right. Which brings us to maybe a final thought to leave people with. We've talked about all these mistakes: overspending, ignoring cash flow, mixing funds. Many of them, when you dig down, aren't just from a lack of knowledge, are they?
What do you mean?
They seem to stem from really basic human nature. Our optimism bias after a good month. Our aversion to the pain of cutting costs, our desire to look successful quickly, maybe even just denial when the cash flow numbers look scary. Our ingrained habits are hard to change.
So the provocative thought is, maybe mastering the spreadsheets and the accounting rules is only half the battle.
Could it be that mastering your own financial psychology, understanding your own biases, building disciplined habits, developing the mental toughness to face the numbers, good or bad, and act rationally, is actually even more critical for long-term entrepreneurial success? Is the internal game more important than the external numbers game?
That's definitely something to chew on. Is it more about mastering yourself than mastering the money?
Potentially. Something for everyone listening to consider about their own approach.
If you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe. And now, don't miss out on the next episode that could change everything for you.